Thanks for clicking. My name is Mark Mitchell. I'm a mortgage broker here in London, Ontario. Bank of Canada Governor Tiff Macklem made headlines a few weeks ago when he announced that the bank was planning rate hikes as early as April. Deputy Governor Lawrence Schembri poured confusion onto that fire a few days ago when he announced that because of uncertain labor market conditions and higher than expected inflation, more uncertainty exists and we can't for certain expect a rate hike in the second quarter of this year. Given that the central bank is supposed to be providing forward guidance and decreasing uncertainty, some consistency would not be out of order.
What do you want?
Nonetheless, the banks and the mortgage lenders have started to price in the interest rate hikes that they see as definitely coming early on in next year. So what I want to do today is do a brief comparison of the mortgage rates that we had at this point in time last month and compare them to the best mortgage rates that we have this month. We're going to see all across the board mortgage rates have gone up substantially, and as a result, more and more reports are coming out that people are rushing in to get pre-approvals as they all see the writing on the wall. We will have more updates out this week as more and more data is coming out on the Canadian real estate market, as well as our inflation and our economic data is currently in flux. And of course, we do have our weekly China update coming out on Friday, so make sure you click like and subscribe to get those updates. But for now, let's get into the mortgage rates. So getting right into the mortgage rates, last month as of October 18th, the best no frills 5-year insured rate, so that's an insured rate, so you put down less than 20%, and it's a no frills product, so that means that there's very little prepayment privileges, much higher penalties should you decide to break your mortgages, and a lot of restrictions on the mortgage. The best rate we had for that was 1.83. That rate has shot right up to 2.33 as of this video. Next up, the best fully featured rate that we had last month on an insured 5-year fixed mortgage. Fully featured, that means that you have better prepayment privileges. Usually 2020, you can increase your payments by 20%, or you can you can put 20% lump sum payments down, as well as less of a penalty should you decide to break your mortgage, and along with just a lot less restrictions. The best rate we had out for that 1 month ago was 2.09, and that rate has jumped up to 2.49. So we can see just based off our two insured products, that's where you have to pay the mortgage insurance and you put less than 20% down. Just off those two products, the rates have gone up by almost 0.5% in less than a month. Next up, the best insurable rate. So that's not insured, that's insurable. So that's where you meet all of the qualifications of having less than 20% down, but you actually have 20% down, so you don't have to pay the mortgage insurance. The best rate we had at this point in time last month was 2.19 on a 25-year mortgage, whereas that has shot right up to 2.64. Now you might be asking why the rate has shot up even more for something where you're not paying the insurance. Well, that's the reason you're not paying the insurance. It's much less of a risk for the banks if you don't pay the insurance because they have no backing. They have no backup if you don't make your payments. So those are a bit more risky. Speaking of riskier, uninsurable mortgages. Uninsurable, that is where you either take a 30-year amortization or you take money out of your house, so like a refinance. So that is uninsurable. The best rate that we had last month was 2.24. That rate has shot right up to 2.69 is the best rate that I currently have access to on an uninsurable loan. So if you remember, if you watched last month's video, we said that earlier on in the year, I actually did a mortgage for 1.84 on a refinance 5-year fixed. Now we see it's up to 2.64. So we do see that interest rates are going quite a bit higher, and it looks like the banks are definitely pricing in the fact that the Bank of Canada will be raising their rates. Whether or not the Bank of Canada wants to keep with a consistent messaging policy on when the timing of those rates are going to be, the banks and the mortgage lenders are already moving into that space, and they are already pricing in these rate hikes. As for what's going to happen next with rates, I think they are still going to continue to go up. The Bank of Canada can try its best to roll back its messaging because it's seeing these rate hikes go up kind of before they wanted them to. I think the Bank of Canada wants rates to continue to be low, at least for the foreseeable future, at least for the next 4 to 5 months, as it's hoping that lower rates will help bring back our economy, help kind of spur some more economic growth, get more people employed, get more people back into the workforce. So I don't think they wanted to see these rate hikes happen. So I think Lauren Shembry came out and said that no, it might not be the second quarter because he does want people to keep borrowing. He wants people to start to continue to, he wants the banks to continue to lend. The banks extending credit and people's borrowing and spending money to a certain extent is the lifeblood of a capitalist economy. So it doesn't want to see that slowed down yet, at least until we've picked up all of the slack in the economy. Meaning once we've gotten back to full employment. So where everybody who wants a job has a job. So I do think that is the bank's end goal, and it's not going to worry too much about inflation for right now. At least that's what its messaging is telling me. With that said, with inflation going more and more out of control, with the US inflation being up to 6.2%, and usually Canada is not that far behind in our track. We tend to follow the US in our economic development and in our inflation rate. If the inflation pumps up over the 5% that the Tiff Macklem has predicted, if it gets up to that 6% range, I can see the Bank of Canada going back on its messaging. It's not like that's unprecedented.
What do you want?
I can see the Bank of Canada going back on its messaging and hiking rates, despite what they told everybody they were going to do. The bank's key concern is keeping the economy on track and getting it back on track. If it needs to bump up rate hikes sooner rather than later, I don't think it'll hesitate. If inflation bumps up to that 7% range, I really don't see that it will have a choice. With that said, as more and more data comes out and more inflation and real estate data comes out, we're going to have updates on that. So click like and subscribe to get those updates, and thanks so much for watching.